Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app. 5th of June, it's a Thursday, it's 11 a.m. It's Dan Nathan, it's G Swizz, it's Mario from SoFi providing some work that he did. Of course, the great Elizabeth Young Thomas will be back with us at some point this year, post-maternity leave, if she's watching. Hello, Elizabeth. We miss you. Dan, how are you?
I'm doing great. By the way, guy, I don't even know if you know this, but Mario is going to be at Fast Money live tonight. He's a huge Fast Money fan, huge Guy Adami fan.
No, he's not.
He emailed me yesterday, said, "What's the attire?" He goes, "I was ready to go full Guy Adami." You know what the full Guy Adami is?
Suit and tie, baby. Knot it up.
That's exactly it. I said, "You know what? You're better than that." I said that, you know what? You're better than that. You roll in however you roll in because you're going to.
That's it. I mean, listen, I don't try to.
I know. It's just it is who you
my
are.
idiosyncrasies onto others.
That's right.
You know, the fact that men now wear sneakers with suits, I'm offended by it, but I acknowledge their right to do so.
But people, when I look off to the side, I'm just looking at Bill snickering because
Bill knows I'm right.
Oh, he knows. He thinks you're funny. Okay, he thinks
I am funny.
And he's a comedian.
Funny.
He's a comedian. So we're gonna meet Mario for the first time face to face. That's gonna be exciting. Watch the show tonight. You guys are gonna sit to see Guy leave the set, go into the crowd, take questions, and this is not him hamming it up. It's just who Guy is, people.
So
the next time we do a live show, you got to come. You got to see Guy Adami in the wild. Guy,
in the wild. You know what else is wild? Nice segue. This S&P 500.
Oh, there you go.
Where you can't keep a good market down. And this morning, I think the future is sort of unchanged. We got an initial spike on the news that President Trump had a phone call with President Xi. The market sold off subsequent. Now we're back to where we started. There's that old saying, I guess, never short a dull market. And it's not that things are dull, but, when in the absence of news, the market just does this levitation. And here we are yet again.
Yeah, and listen, we're going to offer a trade idea using options to actually do that thing that we just said never do, to try to short a dull market. But the options market, especially where the VIX is coming in on the SPY, it's looking really attractive in the near term, right? To kind of put some either maybe short-term protection. We have not done one of these in a very long time, and we just think the timing kind of interesting. We have CPI on June 11th. We have the Fed meeting on June 18th. So we're going to hit that in a few minutes. So stick around with that. We're going to target those sorts of events. We're also going to target the fact that, vol is cheap enough where to make long premium directional sort of things. So we'll map that out in a few minutes. One of the first things that I read every morning, and I think you do too, Guy, is Early Morning with Dave. Dave would be David Rosenberg.
Sure,
Rosie. I thought this was really interesting. And so he's saying outside pandemic era distortions, the S&P 500's 28-day rally from the lows, nearly 20%, was the fastest such move since 2009. So that means that back in April, the index is now up 1.5% for the year and within 3% of its all-time highs. Interestingly, for the economic standpoint, the rally has not been led by growth. Defensives have joined the party as well. So a lot of the headlines are that, Meta's ripped back this and that, or whatever. I mean, a big part of that, or NVIDIA, or whatever the names are that you're looking at, is that they were down a lot more than the S&P 500. So when you see Rosie kind of point this out, Guy, it's the fastest gain, the fastest V reversal since the financial crisis. What does that make you think?
Well, I didn't realize it was 2009, but I knew it was somewhat historic. I don't know what I think, quite honestly. I know what I thought in early April, and we talked about it. I thought the market had probably gotten ahead of itself to the downside. I mean, everybody was seemingly on that side of the boat. The oversold condition was at levels we had not seen in quite some time, and we thought the market would bounce. Now, I thought the market could get to like 5,650, 5,700 in the S&P, and we clearly overshot that. But here we are. So what do I think now? Well, this is what I think. As quickly as we got ourselves to an oversold condition, that's how quickly we've gotten ourselves to an overbought condition. And those valuations, again, not a timing tool, but the valuations that were concerning for a lot of people for so long have gotten themselves right pretty much back to where they were. And that includes a number of different metrics. We talked about the CAPE ratio, the Buffett indicator, just price to earnings in the S&P overall. And they're all once again flashing red. So I'm not quite certain why the market is so optimistic, or just so, to use a word that we've used now a number of times, complacent. But
Yeah.
here we are.
Yeah, and I guess Rosie's point here is also that given all of the uncertainty, we've heard it from businesses, we've heard it from central bankers, right? It goes on and on. We've seen some of the consumer data here. It seems to be that the market is kind of divorced from the concerns about that, which kind of leads you to that whole idea of complacency, which is why I want to hit Liz and Mario's note here, so you know where to get their work. It's at the SoFi Investing blog. You can get there. Look at. I mean,
Can I do it this time?
Yeah, go ahead.
I love this.
Go ahead.
SoFi.com/on-the-money.
Yeah, there you go. By the way, I think you get a little jealous. There's a little FOMO that I get to do that each week.
I just wanted to do it because it's fun.
It is fun, actually. So you can get all their great stuff there. You can get their weekly blog there. You can sign up for it and get it in your inbox there. Okay, so this is what they're looking at right here. Since the April 8th market bottom, the S&P 500 is up 20%. The Mag 7 is up 30%, while AI-related stocks are up 45.5%. This kind of smacks in the face a little bit of what Rosie was just saying, but maybe, Guy, it's just semantics. You know, we talked about the Mag 7 really kind of underperforming to the downside when the market started selling off, and it's obviously gotten a lot bit more of that back. I think what Rosie is saying is that you've seen broader participation of some groups that you might think not be leading the way, right?
Yeah.
So we're talking about breadth, I guess.
And there are a lot of people, if you watch Fast Money, Tim Seymour, you talk about it. A lot of those names that are in the Magnificent Seven, I can't believe I just said it, but because it's up there,
you did,
have become defensive. I know that's somewhat counterintuitive, but for market participants, they view a number of these stocks as exactly that. So when there's seeming unrest in the broader market, the participants will flock to these names as perceived safety or defensiveness in nature, which, listen, maybe it makes sense for Facebook on valuation, maybe Google, maybe on valuation. Apple obviously is everybody's love child, but I'm not certain that's really the right course of action.
Yeah, I guess if you broaden this out, also, this goes back to Rosie's, not just what we're seeing right here, is that, you have an NVIDIA that's only up 6%. And, this has been lapping S&P performance for the last 3 years or so. You have Apple that's still down 19% on the year. You have Amazon that's down 4% on the year. You have Google that's down 10% on the year. And you have Tesla, which is down 4% today, down 21% on the year, right? And so when I look at some of these stocks that are actually outperforming the S&P 500, that fits in a bit into what Rosie is kind of seeing. So I get it. I think both of these data points are really useful. Let's go to the next slide, decoding markets riding the wave. This is from Mario. Despite broader macroeconomic uncertainties, the big four hyperscalers are now expected to spend $311 billion on capex in 2025 versus $304 billion at the end of April. And what's interesting to me, so the annual growth of 43.3% versus 40.2% is that, and you've been making this point, is that the rate of these capex increases has obviously been slowing a great deal.
And that's, I think, the overarching point, that for whatever reason, and maybe I'm wrong to bring it up, but the numbers are bigger, the rate of change is smaller, and at some point that rate of change, flattens out, which is normal, by the way. I mean, you talk about this all the time. I mean, there is a growth trajectory that sort of stalls out, and then you get sort of the other side of that mountain. Now, I guess for names like NVIDIA, what's kept that stock somewhat afloat is the fact that margins are holding in there. I will say, much to my surprise, last quarter, obviously, we saw a deceleration, but they explained that away. We saw a bit of an uptick this quarter. But I think, to me, it's just sort of a matter of time before you start to see deterioration in margins. And that's when I think the story, not that their stories are bad, but that's when the stock stories start to fall on more difficult times. So, again, absolute numbers, huge. Rate of change, not so much anymore.
Yeah, second bullet I think is important. Is something we've also been highlighting. So the timing and extent of any potential overinvestment are unknowable in advance, but for now, robust spending plans make it unlikely that the AI theme will fall apart. Now, you could take the other side of that. You have used this term, the sanctity, all right, of capex. And at some point, and we saw this in 2022 when some of these businesses slow down, the revenue growth slows down, there's pressure on margins, right? These companies have to figure out how to cut costs somewhere, right? And that 2022 was jobs. We're already seeing job announcements, job cuts. Citigroup today, I think Procter and Gamble. There was one other. We know that Microsoft has been cutting some jobs. I think Meta, announced some job cuts, and they're small. They're incremental. But at some point, if you want to start broadening out away from firing people, sadly, you could kind of pull back on capex. And those are the sorts of things as we see unemployment go higher. We know that we have that non-farm payrolls number tomorrow morning for May, but we've seen some anecdotal evidence over the last, not anecdotal, it's actually economic data, Guy, that we're seeing the pace of hiring slow.
Exactly. The soft data has been exactly that. The hard data is starting to come in as well, which suggests, a normal slowdown in the economy, which makes a lot of sense. I think that's one of the reasons why people, and when I say people, it's across a variety of sectors and a variety of industries and a variety of basically positions calling for the Fed to lower rates. I don't think that's the end all be all that most people think, but I also saw, I think right now there's a 79% chance, I think, of a rate cut in June, which comes up on what is it, next week or so? So
June 18th.
Stay tuned for that. And I don't know if my numbers are right, but that's what I thought.
I'm not sure they are. We'll double check this.
Double check. Go to complexity or whatever.
I'm going to the CME Fed Watch tracker because I thought the narrative yesterday was that September was ticking up. So we have June 18th.
Maybe it was September.
We have July. They don't have a meeting in August, but they do have that confab out there in Jackson Hole, Guy. You'd probably love that. Would be the week
fish out there.
That would be the week of the year that I think you would really love to go to. So I'm looking at it's a near certainty, Guy, in June that nothing happens.
Okay, so June is the no. So maybe it was So I got my numbers wrong.
No, that's fine. And let me just look at July. Okay, so July, it's a 70% probability that they stay put. No, that they stay put. Okay, so 30% probability that we get. There it is. Okay, look at Jacob, just Johnny on the spot. So September is the one that's it's starting to turn a little bit, and so that's just sooner than expected. Okay, so all right, let's look at the SPX. This is the index of the S&P 500. Okay, and we talked about this. I'm going to move to the SPY in a second because that's where we're going to do the trade idea in. So we talked about this thing. It's making this flag. It's consolidated above its 200-day moving average. We see that gap above the 200-day. You may say that's really good support. Okay, 57.94 is that 200-day moving average. Let's go to the SPY here, guy. Okay, so this is the ETF that tracks that index. So I just put that uptrend in there, and it speaks to what Rosie just mentioned, the V reversal. It's the fastest 20% gain off of a relative low that we've seen going back to 2009 if you cut out COVID. And you say to yourself, guy, could it continue to kind of walk up that line? Of course it could, right? But because we talked about where vol is right here, we have these two economic events coming in. Maybe the data is hot on June 11th, right? And then maybe we see a Fed that remains emboldened to keep rates higher. At some point, you're going to see a retest. Would you agree of that 200-day moving average?
Yeah, no doubt. I've thought that now for a while. I mean, since that little top we saw a few weeks ago, when we traded back down to the moving average where I thought we would fail and break through it, that was the day, obviously, we held and bounced, which, again, surprised me a great deal. But now here we are, this pretty steep trend line. The steeper the trend lines, obviously, the more chance of it to be broken. And I think you're right to point it out. So 577 in the SPY comes into play. I mean, that probably ticks up a little bit each day, but I think that's what you're looking for. But the real question is, if and when we get there, do we hold this time or is something else going on? And do we find ourselves sort of backing and filling a little bit from the move since April? That's what I think the more likely outcome is.
Yeah, and so that's the kind of target to the downside, guy. You and I both agree.
Hold on a second. Sorry. Jeff H. Would Guy ever call someone bro or dude?
Yeah. Okay.
Tim does that a lot. Tim Seymour does that a lot. I'm not a big bro dude. I'm just,
Yeah.
I like the question, dude.
I don't like the timing of the question here. So we're trying to kind of put this whole thing together here. Okay. So we're talking about you might climb this thing, but by the same token, if you were to kind of go through that uptrend, retest that 200-day moving average. But the gap there is the one that you and I are really most focused on, especially if you break the uptrend and you break the 200-day moving average. Okay, so here's the trade. I put this on a little bit ago, and the prices have moved. The market is a bit higher, so that means this put spread is going to be cheaper here. But I like the risk reward of this. Okay, so when the SPY was trading at around 595.5, I bought the June 20th. Okay, that's the 20th. That's the Friday. Okay, and 3 weeks from now, basically the 590.57 put spread. I paid $4 for that. I was buying one of the June 590 puts for about $5.50. I was selling one of the June 570 puts at $1.50. That's how I get to that $4 in premium. That breaks even down at 586. Okay, and I've gains up to 16 between 586 and 570. That would be the gap fill. My risk is that $4 in premium between 586 and 590. I can lose up to $4. Okay, so let's just talk about the risk reward here. It breaks even down at 586. You can do the math. That's down about $9 from there. That's 1.5%. Think about that. That's 1.5% to the downside, and down about 4.25% or so, I can make up to a little more than 3%. I like the risk reward here. I'm targeting the data. I'm targeting the technicals. I like the fact that I'm risking less than 1% of the ETF price. And so you could say, well, this is not, you're not going for a lot here, but $4 to possibly make 16 if the index is down 4%. I like the risk reward here, guy.
You do that every day. And this is what I like the most about it. You're actually getting paid a decent amount for selling those 570s. Like, I'm actually surprised that you could sell them for $1.50. So that obviously mitigates the cost of the put that you're buying at 590. So I think, again, risk reward makes sense. You're risking 3.5. You're risking 1 to make 3.5, 4. And I think you have a legitimate shot of this coming into the money for you, given what we've seen and given some of the news flow. And I've said this as well. With the market seemingly ticking up every day, there's more and more, I think, chance that President Trump says something that is stronger in tone because he has some basically chips to play with this market bounce. So I think the trade makes a lot of sense.
Yeah, I think that's a really great point too, right? So when we started this whole little foray into the trade war, the administration, the Treasury Secretary, the White House, they said, we're not worried about the stock market. We're targeting the U.S. Treasury market. They wanted the Treasury yield on the 10-year to go lower. All right, so let's go to the 10-year yield, guys. So here we are. We see that flat 200-day moving average. Carter was on Fast Money with us last night. He's in the lower camp, not in the higher for longer camp. He's just focused on the technicals. You and I are thinking about that. The technicals is just one input, right? And so when we think about the reasons for which yields might go higher, if we do have a hotter May CPI, if we do have a Fed that's emboldened because of the uncertainty around the trade war, and we're hearing from companies and talking about prices and they're talking about input costs and the like, and having to pass those through to consumers, well, that's the thing that's likely to keep the Fed, kind of a bit more hawkish, right? Yeah. So what do you make of just the technicals? We see this slightly rising 200-day moving average, but we're basically the 10 years exactly where it was a year ago.
It is. So that's a 10-year. If Jacob or Steven could put up a TLT chart, because over the last, half hour or so, we've seen, interesting. We've seen a pretty steep decline, which coincides with this move higher in the S&P 500, which coincides with the news that President Trump just tweeted, I guess, that he had a great call with President Xi. By the way, not that I'm good at anything, but one of the things that we said when President Trump tweeted at 2:00 in the morning the other night that, and I'm paraphrasing to a point, maybe Jacob can find it, but I'm very good friends with President Xi, but he's very difficult to negotiate with. There's going to be a hard negotiation or something to that effect. What I said, and it's seemingly proven to be correct, it was going to be this overpromise, underdeliver type of thing, where then he subsequently says, as difficult as he was to negotiate with, we had a beautiful call. And that's seemingly what's going on right now, which I think is one of the reasons the market is rallying. But as I said, put up the TLT chart and take a look. I mean, this sell-off today could create a little bit of an engulfing pattern. We traded higher than yesterday's high. We'll see where we close, but this is absolutely worth watching. In the same way that the 10-year yield, the uptrend and the upslope in the 200-day moving average in terms of yields, you have that sort of downslope in terms of the TLT. So you know where I stand. I think the TLT trade's lower from here.
Yeah, and I mean, you see it just from a technical perspective. You see a series of lower highs, a series of lower lows. We're not seeing like a lot of violent price action. Even, it may be 10 basis points is a lot. We saw a decline of that over the last couple trading days or whatever. But I think there is playing out a scenario where maybe yields kind of move slower because you have incrementally better news, and then everyone's kind of not so freaked out about the tweets and this and that or whatever. I just look at the cadence of the communication that we're getting from Trump. And it's just, it goes back to, and whether you want to use a goofy name like Taco or whatever, like it goes both ways, okay? Because, the Republicans have a tax bill and they're calling it a big, beautiful bill. And on the flip side of that, if you have traders coming up with a stupid acronym, Taco, this is where we are right now, people. Some of the folks on the line will say we're in a clown world. Well, we kind of are, right? So however you want to categorize it, I just look at a tweet like that from the president and I say, there's no there. You know what I mean? It kind of speaks to the point that you were saying, that expectations were not high into it, right? And so all you got to do is flatter the guy a little bit and say, oh, well, the first lady and I were just invited to go to Beijing. So it doesn't matter. We're not going to get anything that is material, which goes back to the UK trade deal. They have a surplus with it. I mean, like when you think about it, like we're in good place with the UK. We haven't heard anything from the EU. We haven't heard anything from Canada. We haven't heard anything from Mexico. And we're certainly not going to hear anything material from China. So if you think that a status quo with a 10% across the board tariff around the world is good, maybe that is a good scenario. I don't know, but you're not seeing it reflect in some of the growth data that we're seeing around the world. The other thing I'll say is that the EU, they just said they're done cutting. You know what I mean? So at what point do rate cuts over here help our economy? I'm not so sure if a September 25 basis point cut helps a whole heck of a lot.
Yeah, I think this was their 8th cut in a row. And obviously when people see that, they're like, why aren't we cutting here? Again, my view. By the way, I think everybody remembers what happened in September when we cut. Yields actually went higher on the back of that, and they're still higher than they were in September of last year. So there's a lot of things going on. But for right now, I mean, what we're focused on is the broader market. The broader market seemingly likes what it's hearing on this front. And you have an S&P that's now up almost, 0.4%. NASDAQ's up, almost 0.75%. It's like none of this stuff ever happened. And you hear the frustration in my voice because, again, all the concerns I have are founded, but in terms of the market, they're clearly unfounded. And, that's when this game gets really difficult.
Yeah, and I think it's also worth noting, it goes back to Rosie. It goes back to the data that Mario just showed us. Also, let's look at the banks. We haven't talked about the banks in a little bit here. So let's start with the regional banks. And I know this is one where, this was the kind of source of some problems in early 2023.
Mhm.
We saw some liquidity there. I think a lot of folks thought that Silicon Valley Bank, the regional banking crisis might kind of broaden out a little bit. It didn't. But look at where this index is relative to where it was post-election last year, right? It filled in that gap really quickly, that 1 day gap after Trump's election here. And look at the series of kind of lower highs here, and you saw obviously the bottom fall out, getting to those 52-week lows during that April kind of bloodbath in the S&P 500. But we saw the gap again after we saw a push out of the China and look at it, filled in that gap. You see the 200-day moving average. You see that kind of green support line that we kind of gave. Maybe it's important, maybe it's not, but it really feels heavy right here, Guy.
And this is going to look very similar to the small cap index. And I agree with you. And there's a reason for that, because these small and medium sized banks are extraordinarily economically sensitive, and they are reliant upon the local businesses in the regions that they operate in. And I think this is my view, and I think the data backs it up. I mean, things are slowing down. So it all makes sense in terms of small and regional banks, and it all makes sense in terms of the small caps. What doesn't make sense necessarily is the sort of continued strength in the broader market, and maybe the strength in some of these banks. I mean, we flagged Wells Fargo yesterday. Everybody got all excited about Wells Fargo. I'm going to look and see where it is right now. But, I was a big believer. Like, that was sort of a selling news event the other night when that came out in the middle of our show. And at least right now, it looks like it might have been. I mean, you're talking about Wells Fargo, which was within an earshot of not a 52-week high, Dan, but an all-time high, I think, that we made back in February. I think it was north of $80. So, there's a lot to be excited about, but I think a lot of these big banks and regional banks are in for some tough sledding.
Yeah, so just looking at the BKX, right? So that's the larger cap banks here. This doesn't look good either. I mean, again, we have an S&P that's, 2-3%, away from its all-time highs. We just talked about Mario's data about, the I guess the rally broadening out a little bit. So banks really aren't participating that much. So let's keep an eye on that. Let's keep an eye on the BKX if it's able to kind of hold this kind of 200-day moving average, which is below that uptrend that had been in place. So we just looked at the S&P uptrend, which is still intact, but let's see if we start seeing banks leading to the downside. Now, another one. This is the last, what I would say, important earnings report across the S&P 500 is coming very late in the cycle. It's coming a week after what we heard from NVIDIA. This would be Broadcom, right? So look at this. It was 45% off its December highs. You and I have talked about that, fine. But the fact that it's up now 85% off of the lows at a new all-time high, heading into this print tonight after the close, a 7% implied move in either direction, that seems really cheap to me, Guy. And if you were looking to buy a call, okay, Friday's close, that's tomorrow, 3.5% in either direction. If you're looking to buy a put, 3.5% to the downside, right? So 3.5% potential upside, 3.5% downside. I mean, I don't know how you're not looking lower here, man, after this sort of run, because to me, I don't know what the hell they're going to be able to say that's going to support the rally that we have had over the last month and a half.
Well, remember what they said in December, and that didn't make a lot of sense, and that proved to be correct in the subsequent move into April. And now, to your point, this is a much different setup than we had in December of last year when the stock was still reasonable on valuation. There's this there's one little gap in the chart, probably comes in somewhere around 215, 220. And, I think you see a gap fill, and then you want to play all the way back down to the 200-day moving average, which probably comes in around 195. But to your point, look, could they say something to get some market jazzed? Absolutely. I mean, I'm hard pressed, though, to figure out what that's going to be, given that run that we've seen over the last now 2 months. It's in a word, historic. I mean, this is now joined the $1 trillion club. And I was watching one of the decos on one of the shows on CNBC yesterday, and they were talking about, in Avago, Broadcom being part of the now, I hate to say it again for the second time, the Magnificent Seven. And you actually brought that up months ago.
Yeah, we call it the Fateful Eight, Guy.
No,
Back
not
in
we.
December,
Not we.
you just called it the Mag 7 and you add
I
one
only
more,
did that
and it's the
because,
it's the Fateful Eight. And like that moniker, which I obviously did coin back in December when this thing had that 40% 2-day rally. I mean, just think of that. We're just talking about an 85% rally in the last 6 or 7 weeks off of the lows. In 2 days, it gained 40% or so. So here we are. It took a little bit longer this time around. It is more than $1 trillion market cap. And, the excitement here reminds us a little bit about the excitement in NVIDIA going back 2 years or something like that. So again, your guess is as good as mine what they say to keep this going. But if I could spend $10, okay, if I was long this stock, $10 for the tomorrow expiration 265, I'm looking at it right here, the 265 put, and you have the stock trading at 264, so it's already $1 in the money, and your break even, again, like we said, is down 3% or so. That makes some sense to me. And you know what, I might be looking at that into the close today. Because I don't like binary trades generally using options in and around earnings, but this one looks attractive, Guy.
it sticks out like a sore thumb, as they say. So I'm sort of with you. And look, they are capable of saying just about anything in this environment to get people excited or to continue the excitement. But we're going to find out in a few hours what that is. I don't think it can happen. Real quick, we got a question about silver. It's from Ben M141, if you want to throw that up, and it's about PAAS. So if you go back and look at a chart, by the way, we've talked about silver here, but we're right at levels that we last saw, I want to say, in April of 2022 in terms of Pan American Silver. It's a name that people play in the silver market. If you go longer term, you'll see exactly what I'm looking at. So I think you've been long this stock. I think you got to start thinking about taking some profits, and you can do the horizontal line from those low, and look to fight another day. The silver market, the fits and starts are historic. I think we're setting up for another one. I believe in the story, but it doesn't move in a straight line. So take profits here, in my opinion, in PAAS.
Yeah, if you want a deeper dive into the silver trade, our good friend Peter Bookvar of Bleakley Advisors, he also writes the book report. He was on the On the Tape podcast with Danny Moses. That dropped on Wednesday. They talked gold, they talked silver. It was a great conversation. Check it out. Go to your favorite podcast store, wherever you get your podcast, and go follow the On the Tape podcast. Also, go to their YouTube page. And Danny's doing a lot of great work there and having a lot of great conversations one-on-one each week. So go follow that. Guy, Lululemon, I know you wear the Lulus. This is something that, you wear them when you're working out. You wear those pants when you're just out and about around
No,
town.
I don't wear the pants.
But you do have the shorts,
The
right?
boxer short, the boxer briefs, absolutely.
Okay. So when they reported 3 months ago, you see that gap, right? This is one of those companies where I get it. It became something of, people love the stuff and the stock kept on moving higher and the valuation became, something that people could point at. Every other quarter, it looks like they have a gap higher, they have a gap lower. They're at consumer kind of whims as it relates to fashion. But here we are. We filled in that earnings gap. We're above that 200-day moving average, right? The earnings gap from 3 months ago. Expectations for a 9% move in either direction. I can't imagine, that's crazy to me that implied move is greater than that of Broadcom's, and maybe say it's the law of large numbers as it relates to Broadcom. But thoughts here, because this is wrapped up a little bit into discretionary. It's wrapped up into some trade war sort of stuff. And, how you think about this into the print? This is not
let's look at a chart. So if you go back to the December high, which, by the way, I think December of 2023, was the all-time high in the stock. So if you go longer term chart and draw a downtrend, you will see that we're pretty much right up against. So you draw that downtrend from 2023 and you'll see what I'm looking at. I mean, actually, we're not up against it. We still have a little bit of room to the upside. The double bottoms below, and we've talked about that. That's actually something to watch as well. So I actually think there's a chance that this thing surprises to the upside and you trade up to the third point of this downtrend line that's been in place for the last, 3 years or so, if that makes sense.
Yeah. Why wouldn't you use a word, that word impaling? You use it as it relates to yourself.
No, but there you go. So there you go. So
Steven is just
he's not impaling himself. So what is that level? So let me call it 380-ish to the upside. Yeah, I think there's a chance you could trade up there and make the third point of a downtrend line.
That's a 10%-ish move, right? Yep. And the idea of kind of getting it all in one fell swoop. And this goes back to what we were just talking about, long premium directional, especially into events. You have implied volatility, the price of options pumped up, right? So let's just say you wanted to kind of buy the move, or you wanted to kind of target the move to the upside. If you have a 9% move, if you buy the at the money call, again, this is a 4.5% move. You have to realize by tomorrow's close. It's a tough way to trade options, people. And we obviously would not suggest buying the move. That would be the call premium and the put premium. That would be the at the money.
Pick a side.
Yeah. Well, there you go. All right. I just want to, before we kind of finish this conversation on discretionary, let's pull up the Nike chart here, Guy. And this is one where, you see that downtrend, you see that huge gap from last summer. You see a series of lower highs, lower lows. You had that gap on the last quarter here. We've kind of moved higher. We've almost filled in that gap. We've been consolidating there. You see the 200-day moving average at like $73 or so. And it doesn't have to be today, tomorrow, the next thing. Would you be more inclined to play for a move towards that 200-day moving average, or you think this thing is going back towards its prior lows? Maybe you can pull up a 5-year chart. You see where that is relative to the COVID lows.
Yeah, even if you go a little bit longer. I mean, we actually thought it could get down to the sort of COVID lows, and I think it got close, if I'm not mistaken. But I will answer your question and say you can play it for a bounce here. I think enough damage has been done, and the expectations are low enough to think that you could potentially have a bounce in this name. So again, like Lululemon, listen, I don't think these stocks are off to the moon, but I definitely think they're tradable here on the long side for a bounce.
All right, last thing, Visa upgraded at Mizzou.
Yeah, this is an interesting one.
All-time highs. They've been neutral for the thing for a while. I just hate these sorts. I feel bad for some of these analysts. Sometimes I don't feel bad for this guy right here, because if you were neutral this whole way and you've had this sort of move, let's pull up the chart for a second here. do you kind of just pull the ripcord here, guy, and get bullish? I mean, this is a tough one, man. And the valuation, I know you're going to hit and everything like that. I just don't like these sorts of calls. We're highlighting it because I think it's interesting after the market rally that we had and the relative outperformance here. So thoughts?
Well, it made a new all-time high today, Visa. I think 371. I think at a certain point, analysts get they feel the same thing that traders do. When you're on the wrong side for a period of time, at a certain point, you just say uncle, and traders do it in terms of stopping out, and analysts do it in terms of upgrading names they're neutral or even worse than neutral on, and it happens to everybody. So, and I think that's what probably happened here, and I think the bet is that, look, it's been lower left, upper right for so long that let's just try to catch this last little piece of the move, and maybe they will, but you just said it. I mean, valuation has always been a concern around this. By the way, Visa and MasterCard are names that we have collectively liked for a long time. The only concern is around valuation. It's not necessarily as economically sensitive as people think because it's just a transaction processing company. And again, people trying to fight inflation, they're doing it with their plastic and they don't take credit risk. So it makes sense on that metric, but I think your point is well taken. You hate these types of upgrades because they're so late in the cycle.
Yeah. Last thing, I swear it's last thing. We get inspiration from all different sorts of places. I have the Wall Street Journal webpage up right now, Guy, and this is kind of interesting. I'm staring at this advertisement, which you probably don't see if you have it up, but I put the screenshot into our chat. This is Raytheon connecting our world.
Comes out RTN or RTX now. Actually, used to be RTN.
Okay, yes, it did. So let's pull the RTX chart up while we have, there you go. So look at that advertisement staring me in the face. So what do? I go to my FactSet machine and I pull up the stock here. I know this is one you've liked, the defense names. They had a lot of volatility in April. That's kind of a whole host of things going on there, whether it's trade and all that sort of stuff and defense spending as it relates to China or Ukraine. And look at that thing, man. You can say that was in a bit of a base here, but now that thing is back to those 52-week and all-time highs.
It's all-time highs. I'm going to ask Stephen to do something here, and I'm not trying to tee you up at all, but if you can overlay this chart with the Lockheed Martin chart and then go long-term, they were basically on par with each other until right around the election, and then Lockheed Martin took a nosedive. That's right. Look at you, Stephen. So what I'm looking at there, Dan? They decoupled in a pretty major way, and now Raytheon is off to the races. So you could be putting in sort of a rounding little bottom here in Lockheed Martin, but I think Raytheon continues to do the dance. I mean, it's just a great American company, and they've acquired some companies along the way. So they went from Raytheon to RTX Corp. I think they acquired Pratt and Whitney and Rockwell Collins, I think, if I'm not mistaken. So that's off the top of my head. So I still like RTX here for sure.
All right, pull up LMT just on its own, because this is really, really interesting that you bring up, Guy, the disconnect, or the one dog goes one way, the other goes so Raytheon's trading at 23 times this year. Lockheed's trading at 17 times.
Cheaper.
You look at the move, much cheaper. You look at look at the move from those recent 52-week highs. Now make it a 5-year chart. This is where it really sticks out to me. Okay. Yeah. So look at that. It had that massive breakout. It was a runaway breakout. Then it gave it all back. It came back to that 200-day moving average. It's consolidating in and around here. Is there a trade? Is there I
think so. On the long side, this was the L in my clam last year, and I looked like a genius until later in the year when it cascaded lower. But on valuation alone, I like it. And I think what hurt Lockheed and a lot of companies was the whole Doge thing, and the fact that there was a chance when defense spending was to take a look at, and Lockheed was probably, no pun intended, in the crosshairs of that. I mean, front and center actually, and they paid the price. But you just brought up valuation, and it's still one of the great companies out there. So yeah, I think you can play Lockheed. You don't have to sell Raytheon to own Lockheed. I think you can own both of them.
Yeah, that's an interesting one. Now, the Paris trade might be interesting also, but I hear what you are saying. All right, should we get out of here?
Why not? I mean, we have a big live show tonight, which is going to be fun. I think some of the people, well, maybe not, because maybe they're in New York already and not watching this show, but they're going to be with us tonight. As you mentioned, Mario will be there all knotted up. I look forward to that.
Maybe I don't know.
I hope
we don't know.
I'm about to sit down with Demo. That, of course, is Danny Moses. That will drop tomorrow. That's always worth the price of admission. My sense is he'll even talk about the Belmont Stakes,
Oh,
which take place at Saratoga Racetrack this year. They're back at Belmont, I believe, next year. We have a lot to discuss. So there
yeah.
you go.
So that is in the Risk Reversal podcast feed. So check that out, Guy and Danny. That's going to drop tomorrow morning. Leave a review. That's how people find it.
Yeah.
Share it with your friends, all that.
Smash the shit out of the like button. Didn't we used to say that?
Yeah, you could do that too. However you like to kind of hit that like button. So check that out. Great week for everybody. Non-farm payrolls tomorrow morning. It will be interesting to see how the market reacts to a number that at least investors are kind of getting teed up to kind of see some weakness there. So maybe it goes the opposite way, Guy, if we see some weakness. And weakness might signal greater chance of rate cuts. And you tell me if that's good for the markets. I don't know.
We're going to find out, baby, as they say.
All right, man. We'll see you all tomorrow morning on the Risk Reversal podcast, or you can listen to that there. And we'll see you all Monday at 11 a.m. for the market call. Thanks so much.